Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Normally for the show, I wear my nice Revere collared shirt, either a black or white one. But today, I'm wearing the t-shirt that says, "Got stops." And the reason for that is, thank you, Zach. In Q1, we were talking about riding the wave. And it's gone from riding the wave to treading water to avoid the tsunami. Folks, we've been telling you for years that growth stocks are not meant to be bought and held. Well, almost no stock is, actually. But you need a sell discipline. And when the carnage is over, you need a buyback discipline if that's still a leading stock. Remember, Microsoft was dead money for, I don't know, Don can tell you, 17, 18, 19 years. Cisco Systems, the darling stock of the 90s, almost never recovered. So right now, there's a sector rotation. And the S&P has, seen single-digit pullback from the top, right? But some of these growth names are down 30, 40% or more. They're getting crushed. So either growth stocks will bottom and resume higher, and we get to start riding the wave again. That's, of course, if you didn't lose 30 or 40% and you had a sell discipline. But so growth stocks lead on the way up, but they also lead on the way down. So will this turn into a correction on I'm talking about the S&P now, on the S&P, or even a bear market, or will the Q1 riding the wave resume? In other words, if growth stocks don't firm up and they keep continuing to go down, eventually it's going to pull the S&P down. So what is your plan? We're going to talk about what our plan is. So let's go to Obi-Don Kenobi and Team Revere and get their thoughts on how we avoided the carnage. We got a little pullback with our stocks, but if we had held those stocks, we'd be in carnage. This is especially apropos for people that do Can Slim or IBD or specialize in growth stocks. Because growth stocks will make you the most money over time if you know how to handle them. So, Don, take it away.
Yeah, thanks, Dan. Let's start out with just a look at the S&P 500 here. And this, just looks like you're in a consolidation. Really no big deal. We gapped down this morning, undercut the red line that I'm highlighting. That's the 50-day moving average, but have since recovered it. We put in the low within the first 15 minutes. I'm not going to predict how the afternoon is going to play out, but we did not break below the lows that we set on 7-8, July 8th, which was the last pullback while we were attempting to challenge the 7,600 level and all-time highs. If you look at it on, let's go with a 15-minute chart here. Actually, that doesn't show it well enough. Let's go with a 30-minute chart here. And really, we've been in this trading range between 74.28 and 75.81 on the S&P 500. A consolidation doesn't seem like a big deal. Let's go to the equal weight S&P 500. This looks significantly better than the S&P 500. In fact, this is just a stone's throw away, continuing to make higher highs and higher lows. And the reason for that is we've talked about it a lot over the last couple of weeks. Here's the NASDAQ 100 and its dramatic outperformance. The NASDAQ 100, of course, is tech heavy. Broke the 50-day moving average yesterday, broke the 65 EMA today. This is what I have highlighted here. The 65 EMA is used by a lot of professionals as an overshoot to the 50-day level. It's basically, think of it as the 21 EMA. It represents a month. The 65 EMA represents a quarter. And that's the reason why that level is significant. We don't talk about it a lot, but we track it internally, because the 50-day moving average is really the industry standard. Excuse me. So the indexes look, like not that big of a deal, especially if you're focused on the S&P. Now, there's a reason why on our trend gauge every night we show the trend across 3 time frames on the indexes, but we also show leaders. And leaders, especially AI related leaders, have just absolutely gotten decimated. And to show how important stops are and how bad some of these things have gotten hit, Connor, Todd, and Ted are going to talk about some leading switch to formally leading stocks, because leaders really have petered out, especially anything if it's AI related. Our AI 100 index made a new low yesterday at the close. It's making a low again today, and it's down 10%, while the S&P is basically flat since the end of May. The S&P 500 has pulled back about 2% since the end of May. Our flagship Grotection portfolio has pulled back slightly more than 4% since then. And while we don't like the underperformance, we are a growth stock shop, and that's kind of a minor victory to only be down that much. Let me take a look at, let me show you guys some charts here about how volatile things have actually been. Things that never happen in the market happen all the time in today's market. Here's a 30-day volatility of comparison of the S&P versus momentum stocks. And the white line is momentum. You can see how these things do not move in lockstep. You can see back in 2020, this was COVID, how far that peaked. And basically what we see, and again, one of the reasons why we use the S&P 500 as a major core part of our portfolios, is because all the rotation takes place within that S&P 500. We'll continue to do that. It really does dampen the volatility. Let's take a look at a couple of other graphs here. This is the U.S. momentum stock drop by, this is a Goldman Sachs and Bloomberg chart. High beta momentum is set for the biggest monthly drop since the financial crisis back here in 2007. We're seeing it live because we watch these stocks day in and day out. Let's see. Here's the other one. 3-week realized volatility of the momentum factor versus the S&P 500, just off the charts. This just reinforces the need to have stops on your individual names. If you think it can come back because of whatever story you believe in, one of William O'Neill's key principles is that you buy on technicals and fundamentals, but you sell only on technicals, because the fundamentals will always look best at the top. You'll focus on the fundamentals, you'll see price start to deteriorate, and you'll see, well, my thesis is still intact. The fundamentals are still great. Meanwhile, you're down 25, 30, 40, 50, some of these more than 50%. And that just can't be reinforced enough. We like to use swimming analogies. A little while back, we had a bull on a surfboard riding the wave, and we were continuing to ride that wave as that wave went higher. Then we showed one where the bull was looking a little bit more concerned, and so was the Revere guy riding the bull. And we've gone now from riding the wave to treading water. And the reason why we tread water is because we're going to be prepared to go in either direction. If we see, as Dan said, that things are firming up, leaders are starting to put in right sides of the bases, let's have them stop going down, first of all. But we'll get back on the bull, and the bull will get back on the surfboard. In the meantime, we'll just tread water, swimming in place, whatever you want to call it. But the big thing is to avoid having to call for the life raft or to avoid the tsunami. And that's what our stop process does for all of our portfolios. It keeps us in the game, treading water, to avoid either the next wave down, or to avoid the tsunami, or to avoid having to call for the life preserver. Our life preserver is our stops. Our life preserver is hedges that we put on to avoid taxable gains in some accounts that we have that either brought in legacy positions or have big gains in some of the positions that we've put on, especially the indexes. But you don't want to drown, and the way to drown is to avoid having to ask for that, because we took care of it for you. We will implement the process to keep these large drawdowns from happening. The last 3 bear markets, our drawdowns were less than half. This is the COVID bear market, the 2022 bear market, the flash bull market of bear market, COVID bear market, the 2022 bear market, which was the inflation scare, and the tariff tantrum in April of 2025. In all 3 cases, our drawdowns were less than half, below 10%. On the first wave down. Meanwhile, the indexes were down 20, 25, or 35% in the case of COVID. You got to protect your capital to be ready for the next uptrend. We don't get upset because nobody likes to lose money, but we don't panic or get overly upset as things start going down, because we know at Revere we've got a plan to address any of the 3 situations that can happen with the market, either trending higher, chopping around, going sideways, or trending lower. And it's important to ask yourself if you're qualified to do that. In a bull market, basically any portfolio that's in the market seems heroic because you're making money, but is it really you making money? It's your allocations making money. A bear market is what separates the men from the boys when it comes to portfolio management.
Yeah, everybody's a genius in a bull market. That's the old adage on Wall Street.
That's what they say. And sometimes our protection, which was the case in March, April of this year, we got stopped out right below the 200-day moving average. We were ready for a big drop. That big drop never came. We re-engaged, just basically following our rules, re-engaging as we regained short-term moving averages, regained first the 8, then the 21, then the 200. We had a classic O'Neill follow-through day, and we rode this wave higher, but that wave stopped and chop started, and it all started in the beginning of June with a big down candle, and the range started increasing and getting choppy since then. What are we looking at now? Well, the key level, the S&P 500 right now, the 50-day moving average is at 74.65. Earlier in the week, we talked about 74.50, but right now, that's a key level that we're watching, 74.65. Ideally, we have a day and follow up next week, like we did on 7/8 here, where it was a harsh candle. We closed strongly. We bounced at the 50-day moving average. We went up for a couple of days, consolidated, but then rolled over again. If you're a bull, you want to see a consolidation for a couple of days and then an attempt at a new high. A lot of these AI stocks have been decimated to the point that they're due to bounce. The question then is that bounce
from
on
where?
those individual from where? But is that bounce from oversold an opportunity to start a long position? Or if you stayed long, is it an opportunity to get out of that position, because that's all it is a dead cat bounce? Now, normally when charts are decimated, the way they are, and we're going to look at almost a dozen charts when the fellas do their individual segments. The charts need repair. So this is the time when we focus on our index approach, which keeps us treading water, going sideways until the market decides what it wants to do next. We're having a little bit of a rally off the lows. Let's go to a 5-minute chart on the NASDAQ 100 today. You can see the big gap down, rally higher, a little bit of a sell-off, and now we just made higher highs intraday on the NASDAQ 100. This is as of noon Eastern time. S&P 500, very similar. Gap down, put in the lows within the first 15 minutes. This was the third day down also. We're always cognizant of not doing something on the third day that is a continuation and it means that we're late. In this case, throwing on a bunch of shorts on the third day gap down is a huge mistake because you're already pulled back the prior 2 days. This is the third down where things tend to, there's no ironclad rules in the market, but that's the spot to watch for some sort of a bounce. And that bounce is what we're seeing here today. The undercut and reclaim of the 50-day moving average, the hold of the 7-8 pullback that bounced off the 50-day moving average, and some oversold bounces in a lot of these beaten down names, particularly, let's focus on memory. Here's DRAM. You can see this bounced into a declining 50-day moving average, lost that. We got stopped out there. And it made a third day lower low. That's not the spot to go short. That's the spot to look for some sort of a bounce. And we're getting that bounce right now in DRAM names. Let's look at semiconductors. They're still red on the day, but again, third day down and bouncing at that 500 level in SOX. Obviously, the next question is, like I said, is this a bounce to exit or is this a bounce to look to initiate a position? And you can't make that decision on a day like today. What you can do is make note of the lows of this third day. And if those lows don't get breached over the beginning or throughout next week, then we've got an opportunity to start carving out bottoms of these bases and start to come up the right side. Also look for things that have been extremely defensive, like XLP, Staples. This was up for the third day today. Does that mean buy Staples on day 3? No, because it's had a massive reversal and it's now red on the day. So at the beginning of the day, all of the sectors that are tied to value names were on their third day up with a gap up. They're now coming off. A lot of the growth names on their third day down are putting in a bottom and coming off that bottom. And that makes the lows of today a very simple, very easy spot to reference, not just on the indexes, but on individual names. And then you'll see if we don't continue to go lower, then we'll start putting in additional upside, carving the right side of a base, and looking for what are going to be the leading names. Usually they're the ones that held up the best while the carnage started. I'm really talking names like, and we got taken out of these this week. Todd's going to talk a little bit about this, but DELL bounced right at the 50-day moving average today after just a hellacious candle that got us stopped out on Wednesday. So look for things that held up very well. Software stocks held up pretty well. Cybersecurity names held up very well. In fact, software security and Lilly is about all we have left for the most part in our portfolios. Here you can see cyber ETF bouncing at the 21-day moving average today. This has put in a very nice base, massive relative strength in cybersecurity over the last 4 or 5 weeks after the previous 3 weeks selling off hard. So there's a lot of sector rotation, but really the last segment, the last industry group standing has been software within the AI trade. So another thing you have to be cognizant about is the fact that these held up. Will money now come out of these and go into the beaten down ones? And that's why we like to trim into strength. We did a little bit of that earlier this week in some of these things that held up. but it's quite possible money comes out of those too. The markets are moving faster than they've ever moved. That's not going to change. It's a quick in the versus dead situation. If you hope that your stocks are going to bounce when they start breaking averages, and we don't hope at Revere. We've got a plan for any of the three options that can come out, that being going higher, trending higher, going sideways, chopping, or it being in a downtrend. Dan, I'm sure you're going to add some color.
Yeah, absolutely, folks. That's how the math works. This is probabilities and math. And so the choppiness right now we're seeing and the sector rotation. Now, some of these NASDAQ stocks are getting killed, but there's a lot of sector rotation. This is the hard part of the market. In an uptrend, it's easy. In a downtrend, it's easy. In fact, one thing Don did mention is the lower these growth stocks go, the better off Revere will be, because we'll get a lot lower entries for our new buys when the growth stock rally resumes. But growth stocks over time will make more money than the S&P 500. And that's why we've got a long-term chunk of the S&P, about 20%. We got it based on the 200-day moving average. We got some based on the 50-day. And then we can lever up and down the portfolio quickly based on the 21 exponential moving average. So even though when Don says it's 50% based on the S&P, it really could be 60 or 65, depending on whether we're based on that shorter term 21 exponential. But then the growth stocks, the half that's using CAN-SLIM IBD methodology along with our own internal proprietary rules, they get taken out on their own. And almost all of them have been taken out, like Don said. So I ask you, what's in your portfolio and how detailed are you? Are you doing this for yourself, managing your portfolio yourself? Or are you having an advisor do it for you? And does your advisor sound like Don? And does your advisor sound like the rest of the team he's about to bring up? All yours, Don.
Yeah, let's go right into some of those damaged names, and some of them bouncing today, some of them just from completely oversold levels. But Connor's going to start off with some exits from Turbo and point out how much more the deterioration was after we pulled the ripcord. Take it away, Connor.
Yep. Thanks, Don. So as you saw those charts Don showed earlier, just about some of the worst drawdowns for the momentum basket going all the way back to, the dot-com bubble. What does that exactly look like? And I'm going to show a variety of different stocks from different AI sectors, subsectors, so you can get a picture of really, truly how severe it's been for many of these stocks. So in the fiber optic space, this has been one of the big leading themes in the market. What has been a big leading stock in that theme? AAOI. And this has had a 60% correction from a 233 highs to today's low was 91. That's a 60% correction in this name all the way back to the 200-day moving average. So again, if you bought this stock and you had zero sell discipline, zero stop loss, you just essentially round tripped all of your gains. And this was one of the, quote unquote, fundamental leader. And, Turbo, we tried this on the pullback into around the 50-day moving average, and we were quickly stopped out on May 27th at $169 a share. So again, almost cut in half from where we sold. And that just shows that, like Don said, the market is faster than ever. And if you don't, if you don't sell into strength, or if you don't have stop losses, all those gains, there's saying staircase up, elevator down, and that's what we're seeing in a lot of these names. So that's AOI, one of the fiber optics names. Now let's look at, SanDisk, arguably the arguably the main leader of this market and the main leader in the memory space, which has been a massive theme. And despite this being such a fundamental powerhouse, TML, this just is in a 43% correction off the highs. This went from, 23.54. Today's lows was 13.25. So again, if you're not selling into strength, it doesn't matter what stock it is. Sand seemed invincible for so long, but it certainly wasn't. And this one, if you're holding, you're sitting through 43% decline in the stock. Next one is neoclouds, another huge theme of the market. NBIS, I would say is probably the fundamental leader in this space as well. Not immune to momentum factor pulling back. The stock has gone from roughly 300 to 164. That's a 45% correction. And Turbotection, we traded this name and we got stopped out on it on July 1st at $231 a share. And you can see it's significantly lower from that. And again, the theme of this is, we stop out of stocks and they go higher all the time. But, when you get these scenarios, this is why we have risk management, because not every time the stock is going to bounce. And these are prime examples of what can happen. Bloom Energy is another great one in the power generation space. Similar to the other names, this stock has gone from 351 to 194. That's a 44% correction. And Turbotection, we stopped out on this name on June 26th at $264 a share. So even with today's bounce, that's still 40 points lower from where we sold. And then Rocket Lab, last one. Space has been a really strong theme. Top essentially when SpaceX IPO'd. This stock's gone from 151 to 64, nearly 60% correction below the 200-day moving average in a severe bear market. As with the indexes at the highs. So this one's gotten crushed. And then lastly, MRVL. This one, Jensen Huang was coming out saying this was a $1 trillion stock, and everyone thought it's going to 1 trillion. Well, that was pretty much the top, and then since then it's gone from 329 to 177 at today's low. That's a 46% correction. And one thing is, you have to sometimes try and dip your toes in the water, and we tried this one off the 50-day moving average in Turbotection, but we got stopped out very quickly for less than a 10% loss. We got stopped out at $215 a share on July 13th. And as you can see, it's even low now. So, these, I could show so many other ones. These stocks that I highlighted are, quote unquote, the fundamental leaders in these certain subsectors. And it looks a lot worse for, many other stocks in similar sectors that, had been laggards or just really had no fundamentals and were just moving up on hype and momentum alone. But these aren't just these are strong companies as well, and that's why price is the only thing that matters. And despite the indexes, S&P being just right at the highs, due to the rotation and money flowing elsewhere, if you were a all growth investor holding 10% positions in all these names and you didn't sell, well, then your portfolio is going to be destroyed. And so, yeah, these are just some pullbacks in some of these names and just how much carnage there really has been under the hood.
A great point, Connor, about why it's so important to sell these names if you had big gains in them. Your drawdown is always off of your equity curve high. A 10% pullback off of your equity curve high is a lot worse than 10% if you're comparing it versus where that start came from on your equity curve. Because every dollar that you lose at the high it's magnified because your portfolio has grown as high as it can, and that's That's why it's critically important. Think about it this way. If you started with a 100K portfolio and you were up 50%, now you have 150K. If you drop 50% from there, you're not back to 100K, you're down to 75K. The math, the compounding works for you on the way up. It works against you on the way down if you don't protect those profits or cut your losses quickly. Great stuff, Connor.
Hang on. It's cumulative, folks. Let me put my Don Interpreter on. So let's make the math real simple. Say you have like for Revere, we have a 10% pullback. So you lose 10%. You still have 90% of your capital. If the market goes down 30%, like the inflation bear, the bottom of the S&P, the timing was a little bit different than ours, but it went down 28.5, right? I'm just using round numbers. We were down 11.5 during the inflation bear. Okay, now let's just round numbers. Say it's down 30, the S&P. By the way, Treasury bonds, long-term Treasury bonds, were down 30, but and Revere's portfolio is down 10%. Well, next year when the market's up, and I'm going to make the math real simple, okay? Say it's up 25% that next year. You're getting 90% of those gains the next year versus the portfolio that was down 30%, they're only getting 70% of those 25% gains. Now, it'll still say you're up 25% on your statement from Fidelity or Schwab or wherever, but not on your principal, your capital. That's why it's a smoother equity curve. So you don't get scared out of your strategy. All right, Don, sorry, I didn't mean to interrupt. I just wanted to clarify a little bit more.
Yeah, Todd's going to take a look at some names that held up better going into this week. These were still in our portfolios at the beginning of the week, but we got stopped out as the week went along. And let's see where they are now. Take it away, Todd.
Okay, these are the same 4 exact names we talked about last Friday. And the first 2 were relative strength leaders that were holding up and have been holding up extremely well through the chop in the market. DELL being the first one. This was Grotection's largest position that Jackson and I put on. And overall, as we got down through this consolidation after the last earning gap, the stock was holding up really well along the 21-day moving average. And we pyramided up into a 4% position into this with around a $432 average. So at that point, coming into Wednesday of this week, we were looking pretty good. DELL closed extremely well on Tuesday. And, you know, coming into Tuesday, we were looking pretty good. We were up nicely on the position. And we weren't looking to pyramid anymore at that point because Don has been speaking about how we're not going to buy strength right now. It's just not the right conditions. Well, that's a good thing because you can see on that waterfall sell-off, that really kind of broke the market. And that happened so fast. And I just remember putting in our orders to stop out. And we even started putting them in before our stops were hit. This just didn't feel right. And I remember putting it in right around when DELL was $420 and ultimately getting filled on the first block around 412 and change. It happened so fast. So we got out of it. Overall took about a 5% loss on the position and, lived to play another day on it. 20 basis point hit to the portfolio. But through today, dropped another 10%. And if you don't get out of these things fast, you're going to be in a worse situation. Now we can step back, evaluate how all these things are trading, and go from there. The second one, which was our other relative strength leader, was AMD. Similar situation, just broke our stops. We were really tight on these stops, and you can see there on Wednesday as AMD also broke through we just stopped out of this position. Overall took about a 5.5% hit on a 2% position, and we avoided a further 20% pullback on this into today's lows. So, it was looking all right.
Pullback. That's a bear.
Yeah, and as O'Neill says, there's two types of traders: the quick and the dead. Was it O'Neill that said that, or somebody in the IBD?
I think it was Clint Eastwood. No, I'm just.
Yeah, but again, we have these stops for a reason, and overall, a 5% stop we can live with, and it's a very small hit to the portfolio. Now, finally, getting into the other two, which were the 200-day reclaims. Robinhood was our other trade coming into the week, and reclaim the 200-day moving average was trading extremely well. We had pyramided into a 3% position into this, and you can see where we were really using the lows of that consolidation as our stop loss, and that hit yesterday. So another 5% loser. But again, 10% further to today's downside if you're not acting on these. And certainly if we didn't sell it yesterday, we'd be selling it today into a more unfavorable situation potentially. And finally, Reddit is the fourth example. This was another 200-day moving average reclaim, and same situation. Our stops are worst case right around that 21-day moving average. We stopped out of it. Not quite as bad, but another 7.5% to the downside here. So again, you'll see these 200-day moving average plays often break above once, shake out, retest again, and that's exactly what this one did. So these are lower probability trades if they don't work, and sometimes they take 2 or 3 shakeouts below the 200 before they're legitimate again. So overall, those are what we did with last week's trades, and tight stops, and it really paid off not to get absolutely destroyed in these names.
Great stuff. And another example of sometimes you just got to take the paper cut, and it's all built into the trading stats that we track. The key thing is to avoid the big loss. Speaking of big losses, let's segue over to Ted. Everybody wanted SpaceX at the IPO. We had calls from about 7 or 8 clients.
Multiple clients. Yeah.
Some called back multiple times, and they on the second or third day after it was trading, they were cursing us for not doing what they said, what they wanted to do. We had a plan. The plan is, and we see this a lot, and Ted's going to talk about it a lot. You need a base to buy an IPO, and you don't get that base. You end up with what you see here with SpaceX. Take it away, Ted.
Thank you, Don. So just kind of carrying over the theme of what everyone has presented so far and discussing IPOs once again, I think it's pretty relevant, especially in this year, in this current market environment. If you remember when ChatGPT first came out and this bull market first started, the IPO market was dry. No one wanted to go public. And it's usually a sign that you're earlier in a bull market or you're in the middle of a bear market. But once all these IPOs start going out at massive valuations relative to their earnings and their revenues, and then they're oversubscribed by 2, 3, 4, 5 times, and then on IPO day, it gaps up far above the IPO price. That's just a signal of the current sentiment and frothiness in the markets. So again, we're talking about SpaceX. I've talked about this a few times on the podcast now, and we were all warning on our daily videos, on our podcasts, on our Twitter accounts, that even though SpaceX is the most highly anticipated IPO of all time, it's seemingly a great company as well. It's a quasi-monopoly, as they say, in the space ecosystem. It is always still better to wait, at least for a base, like Don said too. And oftentimes, even over a year, because as we know, for most IPOs, the lockup expiration is 180 days after the IPO. So oftentimes insiders will selling their shares. They've made fortunes since the start of the company. Same with the venture capitalists as well, who are in early. And so natural profit taking is part of the process of an IPO coming to market before it does make what we call it like the institutional advance phase, where institutions do due diligence in the first year. Then they decide, earnings and revenues are growing, they're steady, and price is justified, and then that's when they start buying. You can see that in Hood, Palantir, and many of those 2021 IPOs that fell 90% plus, and that have recently made a big move over the last 3 years. But anyways, this is SpaceX. It made I'm not gonna talk too much about the technicals. It's mainly just reviewing these IPOs and how much destruction can happen. But imagine you chase the first day. Yeah, you're quickly up 30, 40%. But now off those highs, we're down pretty much 50%. And even if you bought the absolute low of the IPO, you're down like 20% now as well. So just wanted to highlight the destruction that it can happen. We would be interested in SpaceX if it can start rounding out a base, reclaiming the 821 EMA, reclaiming the gap days low would be a great sign as well. But we just know that there's a lot of supply still coming to market with the lockups coming out over the next 3 to 6 months. So exciting company, obviously founded and headed by one of the greatest entrepreneurs, but we just need to wait for price to confirm before we just take a stab at this company. So continue on.
Sorry. One thing on SpaceX, the publicly traded float is much lower than the total float. And that's insiders, as Ted said. Those lockups get lifted over the next 180 days periodically, and that's just more supply coming in to the market.
And by the way,
next one up.
By the way, hang on. By the way, those first 3 big candles up, those are the a lot of that is the underwriters called priming the pump, where they start their job is to help support the stock the first few days to make it look good, especially if it's a hot issue, right? And for people, first of all, would you have thought to sold right there at the top after just a couple days, or would you want to hold longer? But if you get an allocation of an oversubscribed or hot issue and you sell it real quick after the pop, you don't they blackball you on the next hot issues. They want you to hold the stock for a few weeks at least, so that so that you're help supporting the stock when it's oversubscribed. So there's a lot of manipulation with IPOs, and it's asymmetrical information. But we don't like that at Revere. Sorry, Don, go ahead.
Back to Ted. The next one is Cerberus.
Yep, another highly anticipated IPO. Sorry, Don.
No, you're right. Another
hot
one.
Yeah, another highly anticipated IPO, Cerberus Systems. Basically, what they do is they create semiconductors, chips that quote unquote compete with NVIDIA, even though NVIDIA really does have a huge foothold on the entire GPU market. But they are a competitor to NVIDIA, largely subscribed. You can see on market search, I can't really read that price, but I think it's around $200. That's what the IPO price was. And it opened up above
185.
185. So it opened up over 50% above 300. I think it was hugely oversubscribed. You can see there's that momentum push on day one, closed at the lows, and it has just been dripping, trending lower ever since. It's just the same mechanics. When these IPOs come out at extremely, extremely large valuations, there will be sellers, and that's precisely what happened with this one too. That's not to say this is a horrible company. You can even see on the left side of your screen, I believe I see 200% earnings growth and 200% revenue growth on an annual basis. So that's incredible. And if that continues, there will be a time under the sun when we can take a stab at this one. Maybe it rounds out an IPO base in the next few months, and we buy back at 300. And you can ask, that is higher, right? But it's a better buy up there if there's a handle versus trying to bottom fish. Who knows where the next quote unquote support level is. So that's, again, like SpaceX, what we're looking for. This is in the declining phase right now. And if it can carve out, one of those saucer or cup type bases, then we'd potentially be interested on the right side. And then the final one is Figma. Again, another highly anticipated IPO, one of the darlings in the private markets. Great company. And this one actually came out earlier, but similar to Cerebus, it had a decent week one and then broke the gap days low and has been trending downward for close to over a year now. And I can't read that off 52-week highs, Don. Is that 80 something percent?
Yes,
And
83%.
Yeah. So 83, 84% off the highs. I don't know the exact math from the gap days lows, but it's probably like 60, 70. So even if you bought the absolute lows on IPO day, you're still probably down 60, 70% on your money. So that is why we really urge, in the modern markets at least, to be careful with IPOs, wait that 6 to 12 months, wait for some sort of base, get back above key moving averages before getting interested again. But definitely have these companies on your watch list. They are extremely quality companies. That's why they are highly anticipated in hot IPOs, because their fundamentals, their story, management are all incredible. Again, just have to wait for the price action to confirm the quality of the company.
Yeah, the fundamentals, you hear it all the time. They can be great, but they're great at the top. It's the price that will keep you in the game, obeying the price action. Dan, that's it from the tech team today. You can take us on home.
All right, folks. So again, do you have stops, especially for your growth stocks? Listen, does your advisor or yourself, do you do this kind of research? Do you go this deep? Because if not, you're swimming with sharks. Anyway, listen, if you like what you heard, please tell a friend, tell a neighbor. We do very little paid advertising. We put out free content every day. Even these guys even work on the weekends and put out some stuff. If you just go to revereasset.com, up in the right-hand corner, there's a subscribe button, and this podcast and our daily market insight video we do every night the market's open, and even tell you what we're doing in any moves we made in our own portfolios, will go to your inbox. Next to it, there's a Contact Us button. And if you want a complimentary portfolio review, or if you simply want to become a client, that's the Contact Us button. Now, you can also go to YouTube and just type in Revere Asset, just Revere Asset, hit subscribe. Zach, our producer, have this show out. What time is it? It is about 11:30 Central. He'll probably have this out by 12:30 Central. And a lot of the stock nerds do it that way, because this show on our newsletter will come out Saturday morning. So there's two ways to get our content, and it's all complimentary and free. And you can always call us at old school at 855 Real Wealth. We'll talk to you next week on your money, not Wall Street's money, your money.
Because it's not about how much you make in the markets, it's about how much you can keep.